Good morning, class.
Good morning, sir.
Good
I
morning,
hope
sir.
everybody is good.
Yeah,
You're doing
very
well.
good.
Okay, so let's see what we can do for today. Today is going to be the end to the topic financial statement analysis. By way of recap, by way of review, what we did yesterday was to look at financial statement analysis tools. So specifically, we talked about what is referred to as horizontal analysis. We also talked about vertical analysis. And we demonstrated how these tools are used to give us the information we want. It is expected that you will go over them. I have shared the worksheet file on all the platforms. It's on the e-learning platform. It's also on the Google Classroom platform. So everything we give you is always on both platforms. So there is no question of whether you are here or there. You can get information from anywhere. So you can download these save sheets and then go through them with the little notes you prepared. Try to understand it. Today, okay, before we start today's work, let me ask if someone has any question or something to say before we begin. Okay, so let's start today's work. Today we have to talk about, let me say something brief about what is referred to as common size financial statements. In fact, it's the same as it uses the same techniques as what we did here, as the vertical analysis, trying to scale all the other values around some base value. For example, if we are preparing vertical analysis for the balance sheet, what we do is we scale all the other values with reference to the total assets. And that's what we did here. So office equipment is 0.81% of total assets. This is this percent of total assets, and so on and so forth. So that's vertical analysis. We employ the same techniques when we are doing what is called common size financial statements. So most people even refer to vertical analysis as common size financial statement. They see them as the same because it employs the same techniques. But there's a slight difference. Common size, from the name common size, what common size financial statements do is that in cases where we have to compare two companies or two subsidiaries in the same group. One is, let's say, two companies. Probably they are in the same industry, but the way they have reported their figures, one is reporting in millions, one is reporting in thousands, for example. We cannot directly compare 1,000 to million. The analysis will not be right. So to do a good analysis, when you have an income statement like that, one in million, one in thousand, you can common size the financial statements. You can reduce them to a common denominator. So you can do vertical analysis. You can scale all the values with reference to a base value. So in the income statement, you can scale all the values down, or you can scale all the values with reference to sales revenue, for example. So when you do that, the figures you get, which is the percent figures, they will not be different from each other, whether whether you are in million or you are in thousands. Once you have scaled the figures in that way, they will be the same, because whether you are reporting in million or thousand, we are scaling your figures with reference to your own. For example, if you are using the balance sheet, your own total assets, the income statement, your own revenue. So all of the figures will be leveled. Then we can do the comparison. That is what we call the common size financial statements. It employs the same techniques as the vertical analysis. Okay. Today, our main work is to talk about ratios. Our main work is to talk about ratios.
Sir.
In ratios, I know that some of you have had a test of ratio calculations. So for some of you, it will probably be a means to revise what you know already. And I also do understand that some of us, or even most of us, are doing this course for the first time. So I'll take my time having in mind the fact that some people are doing it for the first time. If you have any issues as I am going along with the lecture, you have to pause me and then I explain to you. Briefly, we are going to look at the following ratios. Like I said earlier, we are trying to gauge the performance of the organization. We are trying to guess how exactly the company is doing, whether the company is sick here or sick there, or everything is well with the company. So in addition to the analysis we have done already, vertical analysis, horizontal analysis, trend analysis, we also use ratios, sometimes in combination with these tools we have learned already, to do full assessment. So today we are going to talk about ratios. These are the ratios we are going to talk about. We are going to talk about profitability ratios. We are going to compute some statistics that will give us a sense of whether the company is profitable. The company is running itself profitably or not. So we have profitability ratios. We will also talk about efficiency ratios. Statistics that will inform us whether the company is making judicious use of its resources. We'll talk about liquidity, whether the company has enough short-term resources to meet its short-term obligations. We will talk about long-term risk and capital structure ratios. So we'll talk about long-term solvency, short-term analysis of whether the company can pay or not pay and therefore can survive or not survive is assessed through these liquidity ratios. But we also have to gauge long-term wise whether the company has life. I will do this with these ratios. And I will also talk about some investment ratios that investors and shareholders like most, because that gives them a sense of whether if they put their money there, they will be fine. So these are the ratios we are going to go through. I believe that you have already gone through these things because you have the book. You have had a book about 2 weeks now. And you have to follow the lecture by reading through the text on relevant topics before you join the class. So I am taking it that we have all read through this. We are just coming to make things solid. So that's the issue. Now let's take them one by one. Profitability ratios. These are the specific ratios that we will be doing under profitability ratios. Let me use this one. We will talk about return on capital employed, popularly referred to as ROCE. Return on capital employed. We'll get to know the formula, how we work it out very soon. We will also talk about profit margins. And we will talk about, okay, profit margins, we have two in here. So basically, these are the things we are going to talk about. A branch from here will make us talk about assets turnover. But specifically speaking, asset turnover is not a profitability ratio. But when we are doing ROCE, which is a profitability ratio, an analysis into how the ROCE is calculated will have to make us know this. That's why I'm bringing it here. So it is here, and it will also be part of efficiency ratio. So this is efficiency ratio, testing how our assets are working to generate sales. So this is what we will do in for profitability ratios. Let's talk about ROCE, return on capital employed. Let me use this example to explain. I'm trying to make you understand it practically, so you also have to take it from that perspective. You don't have to chew anything here. If you try the chewing approach, it will be very difficult for you. We have all done some investment before. At least we have bought some T-bills before, or we have some savings account. Or let's even talk about the more profitable investment, the one we intentionally go and do. What is the reason why we will want to give our money to some investment manager to work with? What's the reason? Is a question.
Yes, sir. I think because we want to get some interest out of it.
Good. The interest is referred to as returns. So when you put your money into any investment, you don't do so only because if you put the money in your house, it will get stolen. So you want safekeeping for the money. That's not the only reason. In fact, that's not the main reason. The main reason is that if the money lies idle, you will not make any profit on the money. But if you give the money to someone to run the money with, to work with the money, you can make some returns on the money. Yes, a question?
That's why.
Okay. I'm listening. Someone said she had a question. Okay, let me go ahead. So, when capital providers give their monies to the company, they also want returns. In other words, the company itself setting itself up in business is doing so for returns. So the company make returns, but we want to measure the rate of return from using the company's assets. Just like you want to measure the rate of return when you put your money in some investment. And then they will tell you, oh, the rate of return is 13% per annum for T-bills. Oh, this percent per annum for some other investments. So we want to measure the same thing that you know already. When you put your money in an investment, they tell you the interest rates. That's the rate of return. Is 13% per year. So if you are doing T-bill for, let's say, 90 days or 91 days, then you do your own calculation. Okay, I spread it, the 13 into months, multiply it by 3 months or 9 months, whatever. So what would I get as return? That is your rate of return for doing that investment. If the company also goes into investment of employing the company's assets, we should be able to measure the rate of return for doing that venture. And that is done by this formula, return on capital employed. What is the return on the capital that the company is employing in whatever venture it is doing? The formula is so ROSI is equal to profit before interest and tax. That is what we call the operating profit. We have already talked about this, so you should know. Profit before interest and tax, that's the profit the company is making, divided by capital employed. And by now, everybody should know what capital employed means. Who can help us to refresh our memories? What is capital employed? What does it constitute? That's what I mean. What constitutes capital employed?
So please, it constitutes the amount that the investors have put in the company.
Okay, so from your income statement, how do you get the capital employed? Remember, we have done financial statement preparation. We have learned how we prepare balance sheets from all the approaches. In fact, from the two main approaches, where our interest is to highlight total assets and then total liabilities and equity. The other one is where we wanted to highlight working capital and capital employed. So from those lessons, you should be able to know, okay, on the balance sheet, this is what makes up capital employed. That's the answer I want. So from your balance sheet, from your statement of financial position, which things go into capital employed?
Hello, sir.
Yes, madam.
I want to try. Is the
Please, who is speaking? Let me know the name.
is this Annie?
This is who?
Annie.
Afi, okay.
Annie.
Annie, good. Annie, let's hear you.
Non-current asset and current asset give us the capital employed, the total.
Okay,
No.
so Annie has said non-current assets go into it. Current assets also go into it, right?
Yes.
Yes.
And what again? It's not, the formula is not
Hello,
complete.
sir. Hello, sir.
Yes, madam.
Hello. I want to come in.
Please come
To
in.
find the capital employed, it's all as non-current asset, and then minus the liability. That will give you the
Okay,
capital employed.
that's not bad. So this is the formula for capital employed. It is non-current assets plus current assets minus current liabilities. Please try to be specific.
Okay. Yes, sir.
Non-current assets plus current assets minus current liabilities. This is the formula for capital employed. It is also the same as equity plus long-term liabilities. You have to know this by heart. You have to know this. When you add your equity plus long-term liabilities, it gives you the same value as when you add your total assets and you subtract your current liabilities. So, depending on the information available to you, you may have to calculate the capital employed from either the top part of the balance sheet or the down part. Some question may come where information on the assets may not be complete, but you have every information on equity and long-term liabilities. So you use that side to get your your working capital employed. Okay, so that's it.
Hello.
That's the formula.
Hello.
So if you want to rewrite it, Rosie, excuse me. Hello? 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 So if you want to rewrite the formula for Rosie, you can write it as morning. Okay, Martin. Me put me what lectures is here. Until I mean to me for. Okay, yeah, bye. Rewriting the formula for Rosie will be profit before interest and tax divided by total assets minus current liabilities, or total equity plus long-term liabilities.
Hello, sir.
Any questions?
Hello. Yes, hello.
Question?
Hello. Yes, hello.
Hello?
Yes, hello.
Yeah, I'm listening. Speak.
Sir, some books, other thing I have also read, as far as the capital asset is concerned, is that they are saying that it is calculated by taking total asset from the balance sheet and subtracting current liabilities, which will give you a long-term financial obligation. So I don't know whether it is the same thing like what you said.
Raymond, can you speak out a little? I'm finding it difficult hearing you.
Yeah. What I am saying is that other books that I have read, as far as the formula for calculation of capital employed, is that you take total assets from the balance sheet and you subtract current liabilities.
Good.
Which will give you
that is good.
short-term financial obligations. Yeah.
So you take your total assets and you subtract your current liabilities, right?
Yeah. Yes.
Yes. So this is it.
Okay.
Total assets, and this is the same as this one. Non-current assets plus current assets. This gives you the total assets minus current liabilities.
Yeah.
Or most of them will use this formula, but I'm also telling you that if the question lacks information about assets, and some question can be so, you can get the same thing, total assets minus current liabilities, by looking at this window, total equity plus long-term liability.
Yeah.
Because this is the top part of the balance sheet, and this is the down part of the balance sheet, and the balance sheet always balances, so this is equal to this. Yeah. Thank you. Okay, so that is Rosie. What I want us to do is that let's go through the formulas. Oh no, along the formulas, let's try to work with some figures so that we will see how we use the formulas in calculating what we want to calculate. So I'll be doing this. Let me go back to the same book I gave you. That's where I pick most of the information, so you have to be reading that book. Okay, it's here. So let's see. There is a hypothetical financial statement Okay, so it's talking about all the ratios together. There's a hypothetical financial statement for this company, LMN Company. This is the income statement, and this is the statement of financial position. For the ROSI calculation, we pick some figure from the income statement and we come and pick the denominator. We pick the numerator from the income statement. That is the profit before interest and tax. And then we pick the denominator from the balance sheet. Oh, let me check if I think I have some questions for demonstration here. Okay, I have one here, so this will be better. This is more standard than the one in the book, so let's use this. So we have this financial statement for a certain company, Sampa Company. This is the statement of profit or loss, also known as the income statement. And below is, so let me zoom. Below that statement is the statement of financial position. And if we are to calculate the ROSI quickly, let's calculate the ROSI quickly from the formula we have learned. We go to the income statement and then we can know the profit before interest and tax. Let's all take some few minutes. This is the income statement. Let's go through it briefly and let's try to do some calculation of the profit before interest and tax. So I'm giving you just about 2 minutes. If you finish, you can just call me, then I'll make you answer to the class. Because you'll definitely answer a question in this area, financial statement analysis. For now, I am not too sure whether I will set any question on preparation of financial statements because practically you may not be required to prepare one at wherever you work. The softwares you are using will already prepare them. Even if you are the accountant, the software will prepare it, unless you are working in a very primitive organization where you manually prepare it yourself. This has become a software problem now. So I'm still thinking about it, but when it comes to assessing the health of the organization through the ratios, it is more done by you, the human being. You have to make sense from the data you have and make decisions. The machines can help you in the decision making by generating data, but they don't decide. They don't do the decision making particularly. So you'll definitely have a question in this area. So you have to take your time to understand what we are doing, and you have to read well in this area. So what is it? What is the profit before interest and tax, PBIT?
Please, that is 200 cedis.
It's 200 cedis, right?
Yes, sir.
How did you get it? So you picked it from here. Let me check. Here, right?
Yes, sir.
Okay. But listen, this is where, if you get a very friendly question, the profit before interest and tax will be just as straightforward as he has said. But sometimes it's not as straightforward. So the figure 200 is not correct.
150.
See, just after, or just before finance charges and profits before tax, you'll see profit on sale of plant. Do you see that?
Yes, sir. Yes, sir.
Okay, no, not even before that. That is okay. You see these finance charges? The other time, when we're learning, we're talking about the operating profits or the profit before interest and tax. In fact, if you even listen to this one, profit before interest and tax, it should make you understand that this figure is not 100% correct. Because this 200 is profits before tax though, but it is not profits before finance charges. It's not profit before interest. And I made you understand that interest is the same as finance charges. So don't learn and forget quickly. And it can happen to you if you are not reading. So this figure 200 is only profit before tax. It is profit after interest. But we want profit before interest and also before tax.
Sir, please, in that wise, it should be 220.
It will be 220. Okay. So profit before charging interest or finance charges and tax. But this figure, profit before tax, is after we have deducted finance charges, after we have deducted interest. So to get profit before interest and tax, we have to add this 20 to this 200 to get profit before interest and tax. Is everybody okay with this?
Yes, sir.
Yes, sir.
No, sir.
Come again.
Sir, please go over again.
Hey, who is that?
Sir, it wasn't clear, please.
Okay, so we want some profit. The profit before we pay interest to those we owe interest, and profit before we pay taxes. If you look at this figure, it is profit after charging finance costs or finance charges, which is the same as interest. This figure is profit after we have charged this. So we have charged finance charges or interest before we arrived at the 200. So it is profit after, but we don't want it after. We want profit before interest and tax. So to make this one before interest, we have already subtracted the interest from our profit to get this 200. So to get it before interest, we have to add the interest back, so it becomes interest. It is already before tax. We have not yet charged tax because tax is 50 below the 200. But we have already charged interest, and we want before interest charge. So we add the interest we have charged back so that it becomes before interest. Are you okay with that? So that will be 200 plus 20, which is 220, like he said. So this is profit before interest and tax. And please always note this: in accounting, we want the presentation to be snappy. So you see this thing here, million Ghana cedis is on top. So the figure here is not just 220, it's 220 million. So when you are using these short figures to work, you always have to remember that in your final answer, you have to know this: the figures are a million. In your decision making, you have to know that the figures are a million. Otherwise, you are 100% wrong. And that's how some people get failed.
Hello, sir.
Yes, sir.
Hello, sir.
Someone is making noise.
Yes, someone is making serious noise, but
Mr. Charles Kwachi. Charles Kwachi. Charles, please.
Sir, please, I've muted my microphone.
Okay. Olivia, your microphone is on.
Sir, I'm not seeing anything. I'm on it, but my screen is blurred. I'm not seeing anything on the screen.
You are not seeing anything on the screen, eh?
Yes, I'm just listening to what you are saying. I'm not seeing anything on the screen.
Oh, I'm very sorry. But that issue is a problem from your side, not my side. So, are you using a computer or a phone?
Go up and come again.
I've done it several times. For more than 30 minutes, I've been sitting here. I'm not getting it.
Olivia, are you using a computer or you are using a phone?
I'm using a laptop. I'm trying to.
You are using a laptop?
Yes, please.
It shouldn't be so. It should come. I have shared my screen with all the participants in this meeting. Everybody is seeing it except yourself. So it must be coming from your device.
Hello, sir.
Yes, madam.
I'll log out.
Sister Olivia, it's actually a network problem. I've experienced the same thing.
Yes.
I'm lost in parts, right from the formula for the calculation of the ROCE. I can't get anything because my network was totally off.
Wow. Okay, so that's very unfortunate. So it means we have to, if we can change the network that we use to get the internet, maybe in our area that network is not too powerful, so we can change and try to see if we will get a result. Because there is not a problem from my side, so there's nothing I can do about that problem.
Okay, sir. I'm trying to come back again. So
Okay.
Sorry for that.
Okay.
But sir, I hope this lecture is also being recorded.
Recorded, good.
So,
and in fact, all apologies. Yesterday's recording I did, the initial part went bad, but I have about one hour 20 minutes, which start from somewhere. So after this lecture, I will upload it, and this one everything will go right. So I'll also upload this lecture after today. After today's lecture, I'll upload all of them.
Yeah.
The previous ones we have had, I use the Zoom to record, but the Zoom recording and rendering is very poor. So I'm using a different software to do the same job, and I was getting some problems yesterday. So the last week's lectures, they are uploaded there, but you have to bear with how it is rendered. It's not too smooth, but you still can get something very meaningful from it. So they are all there. Okay, so let's proceed.
Yes.
So if we are okay with the 220, and I was explaining that you have to check the top. Sometimes it's in thousands. So we put Ghana cedis 3 zeros on top. That tells you the figures you are seeing are in thousands. So you don't use just these figures, 40, to make your decisions. It could be disastrous. You can fail because, for example, if your figures are in millions and the transaction that you have to do with your business partner is in millions, but you didn't note it to be in millions, and then you did the transaction in tens like this, that can cause your business to fail. In the same vein, it can cause you to fail your exam if you make that mistake. So you have to be careful about those things. Profit before interest and tax is 220 million. So we have gotten the top part of the formula. Then we know the down part. So let's go to the balance sheet. And by now you should also be knowing where you will get some information. Profit is in the income statement. Issues about asset liabilities is in the balance sheet. So quickly you have to know. When we come down, this income statement was not prepared in the form that will make us pick the capital employed straight from the face of the financial from the balance sheet. So we have to do some small computations. At least we know we have the total assets here. And then we only need the current liabilities to subtract from the total assets, and then we are done. So let's see. We have current liabilities. We have current liabilities here. The current liabilities are in the form of bank overdrafts, trade payables, current tax payable, giving us total current liability. So let me do something. Okay, so I had to do some small adjustments to make it more reasonable. Okay, don't worry. So we have total current liabilities as the sum of all the current liabilities. So we can pick this figure. This is the figure we need. We need this figure to subtract from our total assets of 1160 to get our capital employed. So capital employed Capital employed is equal to total assets minus current liabilities, which is equal to 1160 minus the total current liabilities was 480 minus 480. So what is the result? 1160 minus 480.
That gives us 680.
What?
680.
680.
Yes, sir.
Good. 680. So now we have all the parameters for the ROSI formula. So if we come, let's write it freshly here. So we'll see that from those income financial statements, our ROSI is equal to our ROSI is equal to 220 minus 220 divided by 680. 220, which is the profit before interest and tax, divided by 680, which is the capital employed. What does this give us?
0.3235. So 0.3242. 3.5.
3.5.
Okay. It is mostly very difficult using ratios like this one. So we usually, so I forgot to tell you, convert these things to percentage. In that case, you have to complete the formula by adding times 100%. So the complete formula will be ROCE is equal to profit before interest and tax divided by capital employed times 100%. Are you all right? So that's the formula. So when we convert this to percent, you will get
32.35%.
35.
So that is the ROCE for the company. And what does the ROCE speak? What does it tell us? It is telling us this is the return. It's just like if someone asks you, oh, what is the rate of interest if I put my money in this investment? Oh, 13% per annum. This company is making returns on employing its assets at a rate of 32.35%. Not bad. Not bad. But not bad or bad depends. Not bad or bad can be judged with reference to other figures. So this figure standing in isolation can only tell a little. The little is if the figure is not too low, maybe it's good, but it can speak all the information we need if it is compared to something. So normally this is how ratio questions are set. You could be given two comparable companies, two companies that operate in the same industry, and they are comparable in other ways as well. So you calculate ROCE for this one and ROCE for the other one, and then you may want to judge which company is doing better in terms of the returns on the employment of its assets. You could also be given industry averages for the ratios, including the ROCE. So to be a good company, at least you should be an average company in the industry. Of course, to do well, you have to be doing above the average. So we will judge you're doing well or not doing well against the industry averages. And those industry averages may be given to you in the question. Then you will calculate for the company they have given its financial statements to you. Then you compare. So for example, if the industry average was, let's say, 25% ROCE, then this company is making 32.35, then you can speak something better. You can say the company is doing well, it is performing above the industry average. Another way that you could be asked to do the analysis is where for the same company you have the current year and a comparable year, maybe the previous year. Then you could be asked to do computation for the 2 years, this year and last year. Then you compare whether the company is improving or going down on these statistics. So by so doing, you can say the company's ROCE shows is doing better than previously or not, or is doing the same. And then you can add your comment whether the company should work hard to improve it or it is okay. Sometimes too, the question can be a little friendly. The question can compute the previous year's statistics, ratios for you. Then your job is to calculate this year's ratios and then you compare with the previous ones that have been already calculated. So you have to be gauging the questions to be coming from any of these angles. Okay, so for now, we have calculated the ROCE to be 32.35. If we get a benchmark, then we can say the company is doing well and not doing well. It needs to improve on it, or maybe things are okay. Any questions? Okay, so for this particular question, it was like the one I just talked about. The company's previous year's ratios have been calculated for you. You see them here. They start from, these are the ratios. I will bullet them after here, so you will see it nicer when I upload it back to you. ROSI on year end, return on year end capital employed. So this is the ROSI. So this is the ROSI for the previous year. It was calculated as 28.1. Now this year it is 32.35. Someone should say something about how the company is doing with regard to ROSI. Hello, is a question to the class.
Yes, sir. Please, with regards to ROSI, the previous year, which has the 28.1, did not perform well, but it performed well in the current year, which had said the figure has gone to the other side, so I can't see the figure.
The one we calculated was 32.35.
32.35, yes. So that means the current year, the company is performing much better and above average the previous year.
Okay, the company has performed better than the previous year. You can even go
we can
further.
also say that.
Hello, sir.
Hello,
Sir,
Irene.
please.
Yeah, I'm fine.
Please, one person should speak at a time. I'm getting a lot of people speaking at the same time. Irene.
Yes, sir.
Let's listen to Irene.
Yes, sir. I'm fine. We are saying that the ROSI is the capital.
Hey, which people are talking plenty like that? Irene.
Yes, sir.
Now let's listen to you.
Yes, we are saying the ROSI is the capital that we have employed.
No.
Now, considering the two figures that
that's not what we said. Please let me correct that. The ROSI is return on the capital we have employed.
Thank you, sir. That is the return on the capital we have employed,
yes.
Meaning that considering the two figures, this year's returns that on the returns that we had on the capital employed was more than the returns we had on the capital employed in the previous year.
Yes. This is the current year's ROSI.
Yes,
and this is last year's ROSI.
Yes, sir.
You can see clearly that this year the company is doing far better. That's clear. And I was saying that you can even show more cleverness by computing the percentage difference. 32.35% minus 20.
I was doing that. So I was coming to say that you could say that the
so what's the percentage difference? Let's get it straightforward.
It went up by 4.25%.
4.25%. Okay. So when you add this to what they have already said, it makes it more complete. It makes it better. The company is performing better this year in ROSI than last year. This year's ROSI is 32.35%, which has risen by 4.25% above last year's ROSI. That's okay. That's okay. Okay, so that's about the ROSI. Now let's go to other things. Okay, so ROSI is done. Profit margins. Profit margins. Profit margins. We'll talk about two main profits. We can maybe three. Operating profit margin, gross profit. I think I should have written the gross profit first because it comes before this one. Gross profit margin, and maybe let me say net profit margin. What I mean by net profit is profit after charging interest and tax. So net profit. Yes, they also help us to gauge the profitability of the company. We want to know the margins. Margin is your revenue minus your costs. Easy. Hello? Hello, but me what class? What frame me in some hours time, so. Sorry. So the margin will help us to know whether we are making good profits or we are not even making any profit at all, or we are even making losses. So operating profit margin helps us to know how well we are doing in terms of the size of our operating profit, the size of our profits before interest and tax. The gross profit margin helps us to know the size in terms of percentage, our gross profits, and the net profit also does the same thing. So let's look at the formulas. Operating profit margin is calculated as the operating profit, that is profit before interest and tax, divided by sales revenue or revenue times 100%. We normally want to report them in percentages. It makes us understand it better than if we leave them in ratios. So this is the formula. Profit before interest and tax divided by revenue times 100%. It is assessing the profit before interest and tax as a percentage of revenue. So what percent is our profit of our sales? So we can say that, oh, our operating profit is 5% of our sales, 10% of our sales. So that can make us know whether we are doing well. And again, like we did for the Rosie, if you compare it to some benchmark, let's say previous year's performance, industry average performance, or a comparable company performance, that makes us understand things better. So now that we have the formula, let's go back to the question and do the calculation. The top part of the formula, in fact, all of the things for the formula will be gotten from the income statement. So we go to the income statement straight. Okay, so the income statement is here. Operating profit, it was not readily available. That's why we computed it as this. 220, that's profit before interest and tax, divided by revenue of 4,000 million. 4,000 million is 4 billion, right? Is it 4,000 million? So our operating profit margin will be calculated as 220 million divided by 4,000 million times 100%. So let's do that. This is equal to 220 million divided by 4,000 million times 100%. Calculate and give me the figure.
5.5, sir.
4.5.
5.5.
Good. 5.5.
Yes, sir.
Percent. Good. So it tells us that our operating profit margin is a little over, or let's say somewhere around 6%. If we round up, but it's very bad to round revenues up. It's better to round down. So let's say 5%. So our operating profit is 5.5% of our sales revenue. Is that okay for us? It depends on what the company is aspiring to do. Maybe the company, that is okay, 5.5% profit as a percentage of sales revenue. If the target was 10%, then this will not be good. But again, the analysis may require that you compare it to previous year's performance or industry averages or a comparable company's performance in the same area. And this question that we are doing, we are comparing it with previous year's performance. So let's go back to the question.
Hello, sir.
Yes,
a question before that. In a rare situation in a company, is it appropriate to run up a figure? Because I think 5.5 is within the middle. But if it happens to be like 5.8 or 5.9, then it becomes quite reasonable to run up. Because if you run up, what are the implications?
In fact, my saying that it is not too appropriate to round up. In fact, if you round up 5.5, it will be 6. Even though 5.5 is in the middle, it will round up to 6. But the reason why I said what I said, that in accounting, there's a concept we call prudence. And prudence is basically preaching the news that you shouldn't be overestimating. In other words, you shouldn't be quick in counting revenue that is not too concrete or obvious. Even though there's a high probability that revenue will come, it's appropriate that because it's a probability issue, you see it as it will not come when it comes to revenue. I'll use a different approach to explain the same thing. But when it is about cost, even if it is not yet incurred, but it is probable, count it. The reason why you have to gauge it like that is not to deceive yourself. For example, if you do it that way, you think this cost will be incurred. So you added all of those costs, whether they have actually incurred or not. But in the end, you didn't incur them. You don't stand to lose anything. You rather gain. The reverse is disastrous. If there were some costs that could be incurred, they were on a scale of probability, and you said, "Oh, my guess tells me they won't be incurred." So you never included them in your calculations and your decision making. But when you got there, that cost is there for you to pay. Where is the money? On the side of revenue, this revenue may come 50-50. You said, because it's 50-50 or because I'm not too sure. I'm thinking of it like maybe it won't come. And then finally it came. What are you going to lose? You would rather be happy. But the reverse is disastrous. There's a revenue, maybe it will come, maybe it will not come. But you added them because you needed more money. and then on the D-Day, those monies never came. Your plans will go bad.
Yeah, sure.
So that's what the gospel, the prudence concept is preaching, and I think it's good. It's not too bad. So it is from that prudence concept that I am saying that I would prefer that you round down 5.5 to 5 instead of rounding up. It's purely based on the concept of prudence, but most companies will round up. And the tricky aspect of rounding up is that if you round up to 6, you don't have 6, but yes, but your financials will show that you have some bigger revenue, or bigger profit, which is not the case. But if your financials shows you have slightly lower profit, but actually you have it bigger in real terms, that is better.
That is better. Yeah. Okay. Yeah.
Okay.
It is understood.
Okay, so that's it. So this question, we are comparing the operating profit margin of 5.5% to previous year's performance. So let's go back to those statistics. Okay. The question did not ask us specifically to calculate operating profit margin. So they have for here net profit before tax margin, that is after charging interest. But it will be very comparable, so we can compare. So let's assume this is operating profit margin for previous year for the same company, 6.3. And this year we are doing 5.5. Someone should speak about how the company is performing. This year is this. Previous year is 6.3, and this year we are doing 5.5. Someone should pick the two figures and make a commentary on them with regard to the performance of the company in connection with operating profit margin. Yes, Charles.
Sir, please.
Please, let's give it to Charles. Charles Bedu.
Yes, sir, please, per the figures, we can say that the company's profit has gone down by 1.2%.
Okay.
So this year, they went down.
So if you say it went down, you have to also add
that profit, yes.
Complete it by saying the company is doing worse. Okay. So when you are being asked to make a commentary or something like that in a question, write as explanatory as possible. What you said is 100% correct, but for exam purposes, add some additional, write as clearly as possible. Don't assume that, when I say this, it implies this, so the marker should know what you imply. It normally goes against you if you write like that, because the lecturer will not do that for you. So you have to do all of them yourself. Okay. So that is it. The company is deepening. The company is going down on profit, operating profit margin. There is a decrease by 1.something%.
Hello.
Yes, I'm listening. Please raise your voice a little.
Yes. Once again, I am more particular about the words, the choice of words being used, because I just want to. I know that in a financial environment, certain words may have different interpretation depending on where one finds itself. What is in terms of comparison? What is the issue or the difference between worse and down? In case you are painting a gloomy picture of the company, worse and down, in terms of interpretation.
Okay. Raymond, the last part of your, is it a question? The last part, I didn't get it clear.
Yes, I am saying that sometimes words, the choice of words we use in our financial reports may have some level of different meanings depending on the environment. But if you are interpreting this just as Charles said, west and down may be creating a gloomy picture. Which one is more mild and which one is more stronger? Are they the same in terms of interpretation? Either is going either west or down.
Other ways or what?
Down. We said the company was going down.
Ah, okay.
West, yes.
Yeah. I get it. In fact, this is a very good advice. So we have to write as specific as possible. Very, very important.
Exactly.
Yeah, as specific as possible. The company is going down. Company is going down, like he's saying. Well, you are assuming that, okay, we have to understand what you are saying in the context with which you are saying what you are saying. But it will be more appropriate for you not to give that job of someone trying to do the thinking for you. Provide all of the things yourself. Be specific, straight to the point. Company is going down. You can say the company's operating profit margin has decreased by this, has decreased from this to this.
Exactly.
Okay.
Yeah.
Someone has a question?
Yes, sir.
Okay, let's hear you.
Sir, please, the previous percentage was 5.5, which you advised that we shouldn't run it over. Now this one, the difference is 0.8, but in your explanation you are saying it is decreased by 1. But with this one, can we run it over in terms of decrease? Can we do the running over?
In fact, you can do so. It's about 0.8.
Yes, sir.
So in writing those things, you will not be wrong to say that the company's operating profit margin decreased by approximately 1%. So the key word I'm introducing here is approximately.
Yes, sir.
Yes, you can use some of these things without necessarily mentioning 0.8 specifically.
Okay.
Yeah.
Yes. Thank you, sir.
Okay.
Yes, sir.
Yes, sir.
Yes, sir. I have a question.
Okay, I'm listening. Please raise your voice.
Okay. My question is, we know the previous year, the net profit margin.
Your connection is very poor. There's a lot of interference in it. Are you in a car?
No, I'm not. Can you hear me?
I think it's your microphone.
Oh, okay.
So I hear some chi. So your voice doesn't come well.
Oh. Anyway. Okay, let's go on.
Okay.
If you cannot hear me, we can go on. Or can I talk?
Yeah, Kumsin, try hard. You can raise your voice a little bit so we can hear it.
Okay, all right. My question is, we know the previous year is 6.3.
Yeah.
And then this year is 5.5.
Yes, sir.
The company is not doing well. And you mentioned that we can also say the company is doing worse. My question now is that if the 5.5 is more than the industry's what do you call it? Industry's
average.
Can you also say the company is not doing well?
That is if the question is asking you to do so. For this specific question, I understand your question. Your question is based on practice more than exam question solving. So in practice, if you have information on the industry average figures, and even though your company is decreasing in that metric, you can, apart from recognizing the fact that your company is decreasing in the operating profit margin metric, you have to recognize that it is decreasing. It is going down on that. You can also say that, however, the company is still performing not too bad in terms of the industry average or in comparison with the industry average. But of course, the fact that the company is getting worse in that metric from one year to the other by itself is very alarming. You do not judge yourself, well, you judge yourself somehow with the industry metrics, but how you yourself are comparing year on year is the most important thing. Because the industry average is determined by how all of the companies are performing together. So your worsening performance is even going to affect the industry average. So let's say all other businesses are performing worse, they are all coming down. The industry average will be coming down as well. And if a down industry average, you are slightly above it, that may not be the good news that you want to trumpet, because the industry average itself is down. That is why your performance seems to be better than it. So you judge yourself first with what you are performing year on year. That's the most important thing to do. Then for, let's say, commentary purposes, you can add what you said. However, in comparison with the industry average, the company is not doing too bad. That one, you cannot even use the word the company is doing well. No. You have to find some more suitable words. The company is not doing too bad. That is not the same as saying the company is doing well. I hope I have answered you.
Yes, sir.
Okay.
Thank you very much.
Okay, so that's about the operating profit margin. Let's calculate net profit margin. That's the final profit divided by revenue times 100%. Here too, this question I picked, they did not calculate that metric for the previous year. But again, we will assume that this will do for it. I am doing this because I want us to do the full-blown thing. Even though the question is not asking for certain things, for learning purposes, we are doing everything. So net profit margin is net profit, that's the final profit, that's the bottom line, divided by sales revenue or revenue times 100%. Then you pick that metric and then you look at it in terms of its absolute value. If it is big, depending on what the company's expectations are, if it is bigger than your expectations, you can say, okay, we have done well, or not well, if it is the reverse case. But in most cases, you may be required to compare that metric between 2 years for the same company, or between two companies, two comparable companies, or between a company and the industry average value. So let's do net profit margin calculation. All those figures will be picked from the income statement, and this is the income statement. So quickly calculate it and give me the figure. This one, everybody should be able to do it.
So you said final profit over what?
Hello?
Hello, sir.
Yes, sir. You spoke, but I couldn't hear you. Can you come again?
Hello, sir.
Yes, sir, I'm listening.
Hello, sir. Hello, sir.
I am listening, please.
Hello, sir.
Yes, James, I'm listening to you.
Hello.
James. Hello, can you hear
So
me?
you said the net profit margin is close to a final profit over what?
Revenue.
Net
Hello,
profit,
sir. The answer is
You said
3.7.
the net profit margin is close to final profit over.
Net profit margin is equal
So
to...
you said the net profit margin is equal to.
I'm writing it so you can look at the board.
Hello, sir. The answer is 3.75%.
Okay. So someone has done it for us. Please tell us the figures. What was your...
Okay, sir. So my final profit for the year was 150. Divided by the 4 billion by the 100, which gave me the 3.57%.
That is good. So this is equal to 150, right?
Yes, sir.
150 million divided by what? 4,000.
4 billion. 4 million.
Is it 4 million or 4,000 million?
4,000 million.
It's 4,000 million. I think that would be 4 billion.
Yeah, that would be 4 billion.
Yeah, so times 100%.
Yes, sir.
Gives us,
which gives us 3.75%.
Thank you very much. 3.75%. So if the question had provided this figure for the previous year, then we can compare and say the company is doing better in this metric this year than previous year, or the company is doing worse this year than previous year, like we have done for the rest. So for this particular metric, net profit margin, it wasn't part of the requirement for the question I picked. So the benchmark figure is not there. But we all can answer the question if the benchmark figure was provided. That's the most important thing that we want to do. Okay. So that is net profit margin. Let's look at gross profit margin. Gross profit margin. That one, someone should help us to calculate. This is the income statement. Gross profit margin.
Please, gross profit is not showing on our screen.
Who is helping us? Your networks are very terrible.
Sir, please, I can't see the cost on the screen because I have the profit already, which is the 150, but the cost, my cost of sale is up there, yes.
No, we have gross profit. The gross profit is here, 550. Gross profit margin, the formula is gross profit over revenue. And the revenue figure is at the top, 4,000.
It's 13.75.
13.75.
Okay, so gross profit margin. The formula is gross profit divided by revenue times 100%. And from the financial statement, this will be 550 million divided by 4,000 million times 100%. What will this give us?
13.75.
13.75%.
Yes, sir.
So let's go. Please, when you write 13.75 without the percent sign, it is wrong. Because you are giving us a percentage figure. So if you can't write it without the percent symbol. Let's go back to the question. This one, we had the previous year's metric. Hey, who is giving me that feedback?
Please, sir, it's coming from your end.
Okay. So previous year's metric on, or previous year's measure on gross profit margin was 17%. This year was what? 13.75%. 75. Am I right? Let's check.
Sir.
13.75. Good.
Yes, sir.
So 13.75 against 17. Compare and comment. Who is going to do that for us? Comment on the performance of the company with regard to gross profit margin.
Sir.
Hello, sir.
Sir.
Yes, Kate.
Yes. Comparing to the previous year, this year we didn't do well. The business did not do well with the gross profit margin because the variance is 3.25 below the previous year's performance.
By what percentage? You have to add that. I know you
negative 3.25%. It's negative 3.25%.
Yes, but you don't write it like that. You don't say it like that. That's why you are using words like the company has not performed well. The company is decreasing in this performance. So you say the company has performed worse with respect to gross profit margin this year because the gross profit margin has decreased from 17% last year to 13.75% last year. This is a decrease of this percentage. So once you say decrease of, you don't use negatives. I hope I'm clear.
Yes.
Yeah, this shows a decrease of let's say 2% or 1% or 3%. That's better than using the negatives. And I think there was something I wanted to say, I just forgot.
Hello, sir.
Yeah, someone wants to ask a question.
Yes, please.
Who is it? I can hardly hear you. Fred.
Okay.
Is it Fred?
Can you hear me now? Yes. Can you hear me now?
Yes.
Please, can you also use such words like the company has performed poorly as compared to the previous?
Hey. Fred, are you with your children?
No, please, I'm alone.
Okay, say it again. I didn't get you well.
Alternatively, can you also use the such words like the company has
which people are talking? You can't talk while another person is talking.
Original plans for 2020, which we were told was supposed to be a year of growth and some infrastructural, projects.
I think we need to divide that.
And then for just to meet your mind.
Hello.
NS. Are you moved?
Hello.
Hello, sir.
Please, let's all comport ourselves in a mature way. If someone is on the floor, you, as the person is speaking, you cannot speak because if you do so, we can't hear what the person is saying. If you think what the person is saying is not relevant for you, it is relevant for other people. But when someone is talking, you hear other people talking and you can't hear anything. What Fred said, I heard nothing. So Fred, you have to say it again.
Okay, sir. I was asking that, can you alternatively use such words like the company has performed poorly as compared to the previous year? Looking at the profit margin.
Good. You can use that word poorly. Then you support your poorly with statistics, right?
Yes.
Yes, that is fantastic. Okay, so that is it for operating profit margin, net profit margin, gross profit margin. So we are done with the profit margins. Let's look at the schedule, what we were trying to do. So apart from this ones, okay, so these are the profitability ratios basically. But I said I will have to talk about this guy, assets turnover, because when we can split this ROSI into two forms. We can analyze it into some detail, and you will see that the detail will show asset turnover. That's why they see it, but strictly speaking, asset turnover is part of efficiency ratios. So let's see how ROSI can get spread out. So we are trying to spread out ROSI. We are dissecting ROSI. The formula is profit. Ideally, it is profit before interest and tax. And let me chip this one in before I forget. This profit, the profit that we are assessing against the capital employed, for a particular question, they can say a different profit from the profit before interest and tax. The profit before interest and tax is like the default profit we use if the question is silent. But some question can tell you, calculate ROSI, but use this profit, use net profit. In that case, your calculation of the ROSI will use net profit divided by capital employed. The question can tell you use profit after tax, not use profit before tax, but after interest. That's what you use. But if the question is not directing you, then always stick with profit before interest and tax. So this is the formula: profit before interest and tax divided by capital employed. And we are saying that this can be analyzed into this. We know this one already. What is this one helping us to measure? Profits before interest and tax divided by revenue. What is it measuring?
Operating profit margin.
Good.
Operating profit margin.
Operating profit margin multiplied by, this one is called asset turnover. Asset turnover. The asset turnover basically is helping us to know how well our assets are generating sales. So it's like we are spreading the sales revenue on top of the assets that we are using and see how efficiently the assets are working to generate sales. That's the work of the asset turnover. The formula for asset turnover is revenue divided by capital employed. That is if we said the asset is capital employed. And if you have this formula, you will see that this one, I know that most of us are not mathematically inclined. We don't like it. We can be inclined, but we don't like it. When you have this can cancel this. If this cancels that, then we are left with profit before interest and tax divided by capital employed. So what we are saying is that a question can ask you to calculate operating profit margin, ask you to calculate asset turnover. If you are further asked to calculate ROCE, you can multiply the value you got for this one and this one. And you have to get approximately the same value as if you had used this formula straight away. So this is how ROCE can be sub-analyzed. ROCE can be analyzed into operating profit margin and asset turnover. ROCE can be analyzed as a product of operating profit margin and asset turnover. ROCE can be analyzed as a product of operating profit margin and asset turnover. Are you okay?
Hello, yes, sir.
Yeah, this formula is what...
Sir, please. Hello, sir.
Yes, madam, I'm listening to you.
Sir, please, it's not that clear to me. Can you please go over for me?
Okay, let me go over. ROCE. We have learned this formula. ROCE is equal to profit before interest and tax divided by capital employed. We are saying that, yes, this formula is correct, but ROCE can be also calculated using this formula. Profit before interest and tax divided by revenue times revenue divided by capital employed. This one is a different ratio. This one is also a different ratio. This ratio is for operating profit margin. Operating profit margin. Permit me to write in shorthands like this. And this formula is for assets turnover. So the same work that this formula will do, this formula, the formula in the boxes can also do the same thing. So if you use this formula and another person also uses this whole formula, you will get approximately the same values. If that is the case, then the conclusion is that a company's return on capital employed is the multiplication of its operating profit margin and its asset turnover. A company's return on capital employed, ROCE, is a product of that company's operating profit margin and asset turnover. Are you okay?
Yes, sir.
Okay. And this second formula.
Sir.
Yes, Kate.
Yes. Why are you saying and? Is it not over? Because I see it's over it.
Over what?
Operating profit margin over asset turnover.
Which one are you talking about?
I see PBIT and then dash capital employed. Okay. So, okay. I think I'm
Are you okay now?
Yes, I'm okay. I'm okay.
Okay, thank you very much. Thank you very much for being okay. The second formula, this second formula, which can do the same work as the first formula, is what they call the Dupont formula. You can read about it. So when you hear Dupont, it is just analyzing ROSI as a product of operating profit margin and asset turnover. Okay, so that is it for the profitability ratios. Let's go to the efficiency ratios. Efficiency ratios. The efficiency ratios helps us to measure how efficiently we are using the company's assets. And you know the assets. We have non-current assets, total assets, we even have current assets. So specifically speaking, when we are dealing with efficiency ratios, we will be talking about asset turnover. How well the companies are generating sales. How efficiently the assets of the company are generating or contributing to sales. That is measured by asset turnover. We will also be talking about some working capital ratios which help us to measure how we are managing current assets. How efficiently the company is managing current assets. So we'll be talking about inventory turnover period. Inventory turnover period. We will also be talking about receivables. Is also a current asset. Receivables, more specifically trade receivables, collection period. And then we will also be talking about trade payables payment period. We will also be talking about the company's cash collection operating cycle, also known as working capital cycle. So basically, for the efficiency ratios, these are the specific ratios we'll be calculating as a measure of efficiency. We have already done the asset turnover, but for the sake of teaching, let me repeat it. So one asset turnover asset turnover, that is equal to revenue divided by capital employed you can represent it in percentage. It's just a way of communicating, but for this one it has been the tradition that we report it in the number of times. So we want to say that, okay, revenue generation is this number of times the assets of the company. That's normally the way we leave the answer. So let's go back to the question we were doing and see if we have information to solve that question. Asset turnover. Please give me a few minutes. I'm checking something. Okay, so let's go back to our financial statement. Sorry. If you look at the parameters of the formula, asset turnover is equal to revenue divided by capital employed. It means that we will need the figures from both the income statement and the balance sheet. So let's go to the income statement. What we'll be picking from the income statement or the statement of profit or loss is the revenue. Revenue is 4,000. Revenue is 4,000. This one. Divided by capital employed, that we have been using that figure. I think it was calculated as 680. So our asset turnover is equal to 4,000 revenue divided by capital employed of 680 million. They are all in millions. This will give us what? Give us the figure. Hello, what's the figure? 4,000 divided by 680.
5.88 times.
I can't hear you, please.
It's 5.88 times.
5 point what? 8?
8.
Yes.
Okay, so let's say approximately 5.9, right? So we say 5.9 times. That's how we report it. It is telling us that our assets generate sales revenue 5.9 times the asset value. Are you okay with that interpretation? Are you okay, class?
Sir, please come again. Sir, please come again.
This value of 5.9, I said times. You saw the other one we're using percentage. If you use percentage, it doesn't mean you are wrong. It's just a way of communicating. So when you use percentage, you have to understand how you will interpret it. But traditionally, this metric, we put it in number of times or times. So 4,000 divided by 680 is equal to approximately 5.9 times. What it means is that our assets generate 5.9 times sales revenue. The sales revenue that is generated by the assets is 5.9 times the value of the assets. 5.9 times the value of the assets. So if you multiply 5.9 by the value of the assets, you have to get the revenue. That's the meaning. The revenue generated by the assets is 5.9 times, or approximately 5.9 times the value of the assets. Are you okay? Are you okay, class?
Yes, sir.
Yes.
Okay. So we have computed this for the company. 5.9 times the value of the assets. It shows quite some level of efficiency. But it is not complete to say that, okay, because the figure is a little higher, 5.9 times, almost 6 times the value of the assets. So that is okay. We have to compare it. And for this particular question, the question was requiring us to compare this metric with its previous year equivalent. So we go back to the question and look at previous year performance in the same area. I think it should be there. So we have, okay. They gave us net asset turnover. And net asset turnover is the same as capital employed. So we have previous year to be. So net asset is net of the asset, the total asset net of current liabilities. That's the meaning. I have a problem with their usage of net asset. It's quite deceptive. But in this case, they mean the same thing as capital employed. So the formula is correct. Revenue divided by capital employed. The previous year performance is 4 times. This is the figure. 4 times. And this year we are doing approximately 6 times. So it's equal to 5.9 times. So you should be able to make a good commentary. Let's give it a chance to someone who has not spoken in class before. I've forgotten of the first name. I remember the surname. Tete. She's a female. Is she in class?
Yes, she is. Cynthia Tete.
Yes, Cynthia Tete. Cynthia, last year we did 4 times asset turnover or net asset turnover. This year we have done 5.9, almost 6 times. Comment on the company's performance with reference to or with regard to net asset turnover. Cynthia, we are listening to you.
Sir, please, I just joined.
Okay. Who else has not spoken?
Sir.
Yes, who is speaking now?
Olivia.
Lydia.
Olivia.
Olivia, okay, Olivia, let's hear you.
Yes, please. Sir, it means the net asset value of this year is more, the company has done well this year than the previous year. Looking at the percentage rates.
Okay, that is good, but you have to be more specific in terms of your usage of the terms. What we have calculated is net asset turnover.
Sir, it's 2% approximately.
Okay. So the company has done well, has performed well this year than the previous year in net asset turnover, because this year's net asset turnover has increased from 4 times to 5.9 times, an increase of about, is that 2%? Hey, 2 times.
Yes, sir.
Okay, so that's okay. That's okay. So that is for the asset turnover or net asset turnover. Let's go to our board and see other things to do under efficiency. Inventory turnover period. Inventory turnover period. I'm getting tired. Inventory turnover period. That one tries to help us measure how well inventory is leaving our stores to the final consumer. That is the same to say that it is helping us to measure how long inventory stays in the warehouse. In fact, there are 2 approaches to be assessing the same thing. We have inventory turnover. There is no period attached to it. And what I am teaching you right now is inventory turnover period. One is the opposite of the other. Inventory turnover helps us to know the quickness with which inventory leaves the warehouse, so that if the inventory turnover is higher, it means that inventory leaves our warehouse more quickly. The opposite window is to calculate how long inventory stays in the warehouse. The first one is how quick it leaves the warehouse. We can also calculate how long it stays. We are measuring the same thing by looking at the opposite sides. And what I am teaching you is calculating how long inventory stays in the warehouse. If inventory stays in the warehouse for too long, it is bad. It means we are not doing enough sales. And if we happen to be dealing with perishable commodities, we will even run into serious losses through our products perishing or becoming obsolete. Okay, so let's see the formula for inventory turnover period. Turnover period. It is equal to inventory at the year end. So inventory that you find in the balance sheet, that is inventory in the warehouse as at the balance sheet date, divided by the total cost of inventory. But in almost all companies, you will not get that figure, total cost of inventory. So we do this proxy, so cost of sales, because the inventory cost will go into the cost of sales. That's the one you can find in the financial statement. Cost of sales, or cost of goods sales, cost of goods sold. So we want to know how long, right? How long it stays. So we can't leave the formula just like this. How long it stays is telling us something about time. Either this number of days or this number of weeks or this number of time. So we multiply this by 365. That is number of days. 365. So that we will know that, okay, on the average, inventory stays in our warehouse. Inventory is held. So it is also called inventory holding period. Inventory is held for this number of days before it goes out, before people come to buy. So this is the formula.
Hello, sir.
Yes, sir.
Please, the 365, is it constant?
Yes, it's constant because we are measuring how long. So the long, how long part of it has to do with time. Either it's in days or weeks or whatever. So the tradition has been to measure it in days. How long does inventory stay in the warehouse? We are measuring it in days. So 2 days, 44 days, 5 days, 1,000 days. So that's why it is like that. So the 365 will always be 365.
Thank you, sir.
Sir.
Yes, please.
Sir.
Yeah, I'm listening. Please talk.
Sir, some books, the inventory, they put average inventory over cost of sales times the number of days. I don't know whether it's correct.
Okay. In some books, you will find them using the average of the beginning inventory and the closing inventory, trying to find some midpoint between the two. Still in other books, you will find them to be using the closing inventory figure. Now, let's all analyze it, which way is more appropriate. Any of them is okay, but it means that when a question is being given you, the examiner should guide you with respect to his approach, whether he wants you to use this one or that one. And I think we will do that when we set a question in this area. What we are doing is we are using the closing inventory. We are not using the average.
Hello, sir.
We are not using
Hello,
the...
sir.
Hello.
Hello, sir.
Yes, I'm listening.
Sir, I don't understand why the 365 is constant, because we know that in a leap year, we have 366 days. So in a year, when you are calculating it, you know that year, the inventory turnover, that year is a leap year. Would you be wrong if you make it 366?
You will not be wrong for practical purposes.
Okay.
You will not be wrong. But you know this one is, we are learning in the classroom, right? So for classroom purposes, for exam purposes, let's say I give you an exam question. Unless maybe I add to the exam question information that this year, this particular company year, it was a leap year. It's not too necessary. How many leap years do we have in the whole cycle? I think we have only one.
One every 7 years, one.
Yeah, so
yeah,
it might not be too meaningful to be knowing whether this year is a leap year. So in almost all textbooks, even though what you are saying is 100% correct, there can be a leap year where one extra day is added to that year. Almost all textbooks, they ignore that one. In fact, that one doesn't make any difference. If you add 1 to 365 to make it 366, the value you will get for the inventory turnover period will approximately be the same. The one will not cause it to change significantly to be different. Okay.
Thank you.
So 360.
Hello, sir.
Yes.
want to know if there is sales return. Will you add it to the inventory before we do the calculation?
No, sales returns. It's a good question. But normally, no, we don't do it like that. It is assumed, and not even assumed. Practically, that is what it will be. Before you arrive at the year-end inventory, the sales returns would have already been adjusted. I don't know if you understand what I'm saying. Before they come up with the figure for inventory that, oh, this is the amount of inventory in the warehouse at the end of the year, they would have already added the return stock if it is not sold. They would have already added it. Yeah.
I'm asking
Do you understand it now?
Yeah, I understand it, but I'm asking this because in a previous example, when we were doing the gross profit, we saw that 2,000 was deducted from the gross profit. So we have to add it before we did our calculation. That's why I'm asking this.
Oh, okay. So if you understand it now, that is great. That is good. So let's go back to our question. Our question, the closing inventory holding period or closing inventory turnover period. So I think I have to be specific when I'm setting the question. It will not be specific if I say inventory turnover period, because someone can use average inventory and another person can use closing inventory. So the question will be more specific, whether average inventory turnover period or closing inventory turnover period. So please, if the question is specific, do that specific thing. We are calculating closing inventory. So closing inventory turnover period. It is the closing inventory divided by cost of sales.
Sir.
Yes, sir.
Ebenezer, if he can do something about the video, because certain things that I saw is not good.
Raymond, you have to raise your voice a little.
I am saying that Ebenezer's shoes I saw is not good.
Ebenezer has done what, please?
And he should do something about his video, because certain unseen things I saw is not good.
Who is Ebenezer? Some of these things I think I have to take an action. If you do that, then I'll just take you from the class. Because we are not joking here. I don't know why simple thing we can't comport ourselves to do it. When you put your video on, it reduces the network strength. So when I speak, other people find it difficult to hear and so on and so forth. What do you need a video for? What are you watching?
Wow.
Cynthia Tete, your video is on. Put it off. You don't need a video for anything. Ebenezer, your video is still on. Ebenezer Kwajo Benin.
Hello, sir.
Yes, sir.
Yeah, I just want to say that this goes for all our lectures, because it looks like a lot of people enter into this all the lectures with videos.
Yes.
And nobody wants to watch anybody. We only want to watch the lecturer.
Exactly.
So if you all the lectures, yes, you don't have to come on with video. That's all.
There is no need. Even myself, because the video can interfere in the strength of the network and the quality of the delivery. I have configured my Zoom in such a way that I log in with my camera automatically off. Because you see, when you want to look at me, I have my picture there. That is all you need. You don't need to see my my face live. What you need to see live is what I'm calculating, is what I'm showing you. That is what you have to see. When we are teaching, what we have to see is the material we are displaying and the calculations we are doing. We don't need to see anybody's face. That's not material for now. When we close the lecture and you want to converse with yourselves and you want to do socialization, then you can turn on your cameras. That one, it's not my case. It's your own issue. Okay, so
apart from that, we should all be mindful to a standard. Anytime we show our video, we should be very sensitive and careful about the environment we find ourselves.
Exactly.
Because the way people can show their naked
Raymond,
parts,
there is no need to even show video. Raymond, the thing is, there is no need to show video. Nobody has to show video in a lecture.
I agree with you, but the way people are exposing certain things is not good.
What Raymond is saying, I think about 3 days ago, I was watching something on YouTube, and there was a video, YouTube video, where I think they were having video conference. Sometimes, depending on the situation, you may need your camera on, but like he's saying, you have to be careful about the background. Someone was in a meeting. I think it's a routine meeting they do from time to time. So he had joined the meeting, his camera is on. Maybe he had forgotten himself. He had come out of the bathroom. He was alone in the house. Bathroom naked, and his whole body is showing in the camera. They were even trying to signal him, they are calling him, but he was away from the device, so he's not even hearing. And it can happen to anybody. So when you are entering a video meeting, you can configure your Zoom in such a way that you don't enter with your video and your audio on. When you enter later, you can turn them on. You can do those settings. It's very important, because sometimes you wouldn't know the conversation you will be in before you enter the meeting, before you say something that is not pleasant for the meeting attendants. Or like Raymond is saying, you wouldn't know where you find yourself before you enter the meeting, before some people see what they are not supposed to see.
Maxwell, mute.
Why no?
Maxwell, mute.
Okay, so that's just by the way. We were doing. What were we doing?
Yeah, closing inventory.
Yes. I was speaking on the closing inventory thing.
Somebody asked you about the thing.
Yes, so I was saying that the question will be specific whether it's closing inventory holding period or average inventory holding period, and that if the question is specific, you have to do that specific thing. But of course, for this exam purposes, it is closing inventory turnover period. It's closing inventory. It's not the average, because that's what I'm teaching you. So we want to gauge at the end of the financial period. This is the amount of inventory we have in the warehouse. That is inventory we have not sold. If we divide that amount of unsold inventory by cost of sales and multiply it by 365, we are trying to gauge how long on the average inventory sits in the warehouse before it gets sold out in days. That's what we are trying to do. So let's go back to our question. For our question, so we need inventory at the end of the period, and then cost of sales. These are the things we need. The 365 is constant. So let's go. Inventory, all of them will be, okay, inventory will be picked from the balance sheet. So inventory figure is 250, right? Inventory figure is 250. And then let's see the cost of sales. Cost of sales is 3450. So this will give us this will give us 250 million divided by 3450. So what will this be equal times 365, sorry, times 365 days?
Is 26.44.
Good.
26.4, sorry.
It's equal to 26.4 days. Remember to bring the days because of this. We are measuring the whole thing in days, which is approximately 26 days. Since we can hardly interpret 0.4, we don't know whether the 0.4 is 4 hours. Yeah, the 0.4 can be 4 hours, but we want it in absolute days. So if it is, let's say 0.5, you can round it up to make it 27 days. But this is below 5, so we will approximate it to 26 days. So on average, an inventory sits in our warehouse for 26 days before we sell it out. For me, even without comparing to anything, these days seem to be too much. Because ideally in Kaubenya, immediately the inventory comes to the warehouse, the following day they go out, if not the same day. But these inventories are on the average sitting in the warehouse for 26 days before they get sold out. It's not too good, even if you look at just the figure. On top of that, we have to compare to how we are performing, how our performance this year compares with the previous year. So if we check this 26 days with our previous year performance, is closing inventory holding period, 46 days. Wow. So 46 days reduced to 26 days. Yeah, I think the company is doing well in terms of improving that efficiency. Company is doing well. It has reduced the days from 46 days to 26 days, and you can compute the difference in the days and add it to your commentary. Any questions about that? Closing inventory holding period. Closing inventory turnover period. Any questions about it?
Hello, sir.
Yes, madam.
Please, the days, do you have to interpret it?
The days?
Yes, please.
In fact, the interpretation is what I said. If you get the days, it's only saying the number of days the inventory is sitting in the warehouse before it gets sold, before someone comes to buy. So on the average, when we go and bring things for sale and we have put them in the warehouse, it will be in the warehouse for 26 days before someone will come and buy. 26 days is still on the higher side, even though the company has done well by reducing the days from 46 to 26. Yes, so in your commentary, we have to see these things. Company has improved on the days, on the inventory turnover days, decreasing it from 46 to 26. But you still can add that even with the 26 days, the company should do better to reduce it. And you can even add issues like, sometimes the question will not have those information, but as a good student, you can add something like 26 days if the company is dealing in products that suffer from obsolescence and what do we call it? Yes, if it is a fashion product, you know how fashion can get archaic very soon. Almost few days, new fashion is coming in. So if you go and bring some fashion wear and it sits in your warehouse for 26 days before they get sold, the risk is high. The risk is that most of your inventory can get archaic. Nobody will like them because the fashion is outdated. If you are dealing with highly perishable products, a product sitting in your warehouse for 26 days. 26 days is how many months? It's not up to a month. Getting to a month. Yeah, if let's say fresh juice, which is not preserved in any way, sitting in the warehouse for 26 days can make it go bad. And apart from you losing money, maybe you can't sell it, you can also go into the problem of if you make a mistake to sell and someone gets health problem, the likelihood that you will go into litigation problems. All of these things are there. And good students will read and tie these things in his commentary. And that is why some students get a better mark, because these are professional marks. They are always not part of the main marks that we award to students. I'm just saying this for you to know how well you should write. You have to understand you are master level student. So your writing, your argument should reflect that level of academics. Is that okay? I hope that is okay.
Yes, sir. It's okay.
Yes.
When is the class supposed to close?
9:30.
9:30.
Okay, I have 30 minutes. 30 minutes more to go. So let's go. The next thing on the agenda is where did I keep this thing? Where did I keep these things? Okay, the next thing is let's go straight to the point. I was looking for where I made the list. The next thing we have to talk about is receivables, trade receivables. Trade receivables collection period. This one tries to gauge, helps us to measure this. When we sell, when the inventory finally leaves the warehouse after 26 days, the standard business practice is to sell on credit. Okay, so that's the assumption. When in 26 days, customers come and pick the products on credit, how long does it take them to pay back our money? That is what the trade receivables collection period measures. How long does it take them to pay? Like we have done for the inventory turnover period, the how long is measured in days, so the 365 will be there. So the formula is...
Hello, sir.
Yes, sir.
Yes, sir, I want to ask a question.
Please, you can ask.
Yes, let's take a customer who sells cement.
Okay.
You know, these customers, the cement, when they bring it, within, let's say, a week or 2 weeks, they are sold. So I'm just relating to with regard to the 26 days, the one we calculated,
okay,
and how practical it is.
Hello, the last part of what you said, I didn't get you.
Yeah, I'm saying that if you take a cement seller,
Yes.
you know, they bring in the goods and then it moves as quickly. But I've just related it to what we did and we had 26 days.
Okay, so what you are saying is that if you look at the trend in those who sell cement, the trend in their business,
yes,
when
yes,
they go for the cement in 2 weeks, they get sold off, right?
Yes.
Fine. So if that is the practice, if that is what happens in that industry, then if you pick any particular cement dealer or cement sellers financials and you are assessing and you see that the inventory holding period is 26 days, then that tells you it is far higher. It is worse compared to the average. Because the figure you are giving us is that on the average in 2 weeks, 2 weeks will be how many days? 14 days, right?
Yes, 14 days.
Yes, in 2 weeks, in 14 days, it should go off. But this particular cement person, cement seller, his closing inventory holding period is 26. That tells us straight away that this is at variance with what should normally happen, given what happens in this line of business. Yeah, like I was saying, sometimes the figure by itself alone tells you no, it is no good, even though it is an improvement over the previous year. Yeah. Thank you very much. Okay, so trade receivables collection period, if in 26 days or whatever period customers come to buy, how long does it take them to come and pay? So the formula is trade receivables so it will be closing. We are using the closing balances. So the trade receivables you find in the balance sheet, that's the closing value, divided by this one we are selling to demo, so divided by credit sales. The amount of inventory, the amount of trade receivables in our balance sheet divided by the credit sales that generated those receivables. The credit sales times 365. But this one, most financial statements, you will not get a credit sales. They will just tell you revenue. And they will not show the difference between those that happen on credit and those that happened on cash basis. In that case, you use the sales as the proxy. So that is why all the things we are doing, we are estimating, we are gauging. So they are not absolute. So your interpretation should reflect the fact that they are estimations. And a typical example is the fact that even though it has to be credit sales, maybe you didn't get the credit sales figure. It's mixed up with the cash sales. So you pick the whole of the sales. Any figure you get is only approximating, is only trying to gauge. It's not telling you hard and fast that this is what it is. So credit sales, but if the credit sales is not there, you use the whole sales figure. In our question, the question was friendly. It gave us the credit sales figure. If you look at the revenue into bracket 25% cash sales, it means 75% credit sales, right? So you compute 75% of this, that will be the credit sales. Now you can get more accurate. But in case this thing in bracket wasn't there, you have to use the whole of the 4,000. Now let's calculate once we know the formula. The receivables figure in the balance sheet is trade receivables. Do we have trade receivables? Current assets. Sorry, let's go to current assets section. Current assets, trade receivables of 360 divided by credit sales of 3,000, 75% of 4,000. Please check for me. 75% of 4,000.
3,000.
Yes, 3,000.
Yes, 3,000.
So this will be 360 divided by 3,000 times 365 days. So what will this be? What will be the number of days? Hello, quick. What will be the number of days?
43.8 days.
43.8. So let's say approximately 44 days. So approximately 44 days. So when customers come and buy from us, it takes them 44 days. Please excuse me. Hello? Hello? It takes them 44 days for them to pay us the money they owe us. Just by this figure alone, it is not too good, because I know that on the average, the standard credit period, the maximum is 3 months. Oh, okay, 45 days is less than 3 months. Yeah, so I was interpreting it in terms of months. 44 days will be how many? 1 month and some days, right? It will be 1 month.
1 month, 2 weeks.
1 month, 2 weeks. Okay, 1 month, 2 weeks is within reasonable time. 1 month, 2 weeks is within reasonable time. So the figure by itself alone is not too alarming. But we do well to compare this current figure with previous year's figure and see whether we are improving or we are worsening. So if you go back to the question, you will see the figures are there. Trade receivables collection period, 45 days. 45 days previous year, we have only reduced it by 1 day. So it's almost the same. It's almost the same. And in fact, this one, we have to be practical. Sometimes, around this issue of collection days or collection period, there is not so much you can say unless the days are so high or we are worsening in the days, because 1 month, 2 weeks is a normal thing. You cannot say because the company has added 1 day, so the company is doing worse. And of course, if you attempt to reduce the receivables collection period below 1 month, 2 weeks, you have to also know the consequences that may result in you losing some sales. Because if you give credit of 1 month, 2 weeks, for me it's reasonable. If you think it is too much and you reduce it to, let's say, 1 month, it's not all your customers that can pay you back in 1 month. If you still even reduce below 1 month, not all customers, you may lose those customers, and that means your sales revenue is going to reduce. So if you are interpreting around the receivables collection period, you have to also link it with the possible impact on the sales revenue, because they normally adjust the collection period having in mind the effect on sales revenue. Some of them, a typical company might have even increased the days from 45 days to, let's say, 60 days, which is 2 months, with the aim of boosting sales. So you will have to check this this increase in the days with any increase in sales revenue between the two periods, if the information is available, so that in your commentary you have to show all of those things. Is that correct?
Yes, sir.
Yeah. Then let's talk about. Yeah, Charles, you have raised your hand.
Yes, sir.
Hey, who is doing that?
I was saying that.
Who is doing the construction there?
In as much as we should consider the number of days that we can get our money, I think another factor also comes to play.
Charles, but raise your voice a little, okay? What you are saying is very important.
I was saying that other factors also come to play. When we look at, let's say, the shelf life of the product.
Okay, fantastic.
So, and we also look at the inventory, the last one we just did, the trade inventory.
The perishability of the inventory and all those things.
Yes.
Fantastic.
Because if you see that, if we consider that in that one, the inventory turnover period was 26 days.
Yeah.
And we know that the shelf life, if it's shorter, then we have to sell quick.
Good.
So we have to consider, we don't have to bother so much the credit period. Because if you don't sell on credit, the goods may perish, and then
thank you very much.
You rather lose
Charles,
everything.
I think your point is very brilliant. So, in addition to looking at the effect on sales revenue of any adjustment on the collection days, the number of days you give to your customers to pay, Charles is helping us to understand that other factors like the shelf life of the product. If the product is highly perishable, you don't have any option than to sell it quickly. But if you are selling cement, cement can have a relatively shorter, because it can get caked. But if you are selling something like a phone can have a very long shelf life comparatively. And your inventory days are maybe shorter. We will look at the whole circumstances, and that may be fine. So we don't expect someone who is selling phones, and the phones have long shelf life, with someone who is selling tomatoes or contomere, where the shelf life is very short. In few days, they are getting spoiled. If you are dealing with products like that, the shelf life, the perishability alone can pressure you to sell quick by extending credit. Would you free? Oh, budget. Time up because if you don't do it like that, you will not be able to recover anything from it. Will be total loss. So that factor is also there for you to look at. So if you are reading the question, you have to be looking for information like this. Or even if the question does not provide the information, you can infuse some of these things into your general commentary. That will make your commentary more intelligent. Okay, thank you very much, Charles. Let's go to, so we are done with trade receivables collection period. We have trade payables payment. Just as we have to receive money from our customers, we have to pay our creditors. Trade payables payment period. Payment period. And you can guess the formula. Is trade payables divided by when we buy. In fact, trade payables are those we owe the goods we buy and sell. The cost of what we buy and sell is embedded in the cost of sales. normally you cannot have it as a separate item. So that will be cost of sales times 365 days. That's the formula. So the closing trade payables divided by cost of sales times 365. Let's go back to our question, and all of us should try to, and of course you should have this file. I put a file on all your platforms, on the university LMS learning management platform and the Google Classroom that is running as a backup. They are all there, so wherever you find yourself, you have the same information. Nobody is disadvantaged in any way for having the Google Classroom running. I don't know why people have issue with that. If you don't like the Google Classroom, it's not by force. You can decide not to go there for the whole of your life, and you don't get punished for doing that, because the same information, in fact the information are first put on the university platform before we bring it here. So you should have it. So if you have it, you can check the figures and calculate the trade payables payment period. Let's try to do that. I know majority of you don't have it. Majority of you did not even visit the site before coming. So trade payables payment period, we look at the trade payables. Okay, so liability section, trade payables. Trade payables are here. And the current liabilities, trade payables of 430. 430 divided by cost of sales of 3450. 3450 times 365. What's the value? What's the number of days? $45.5, approximately 46 days. So that is
45.49, approximately 45.5.
Approximately 45 days. 45 days. So just like we've been doing for the rest, you look at it, 45 days. So it takes 45 days for us to pay. 45 days will be 1 month. 1 month, about 2 weeks.
1 month, 2 weeks, yeah.
So sometimes this is what you have to do. There is a linkage between the receivables collection period and the payables payment period, because it's cash flow. If the people we sell to are not paying, then where do we take the money to pay the people we owe? So you will see that naturally companies try to balance the liquidity by trying to balance these two things. It is most likely for you to see a balance, or approximately a balance between these two figures, or these two statistics: receivables collection period and payables payment period. And we are seeing a similar thing. It was taking approximately 1 month, 2 weeks for our customers to pay us. So we are kind of taking that risk of lack of cash away by also deferring our payment by the same period. That's what the company is doing. So by that, the company is managing the situation intelligently. But the company also needs to be sure that by so doing, it is not incurring any bad will with its suppliers, which can cause it to lose the suppliers. So these are the things that we need to see in your commentary. Okay, so what other thing do we have to calculate? Okay, so that's about the efficiency ratios, right? Yes, I said the cash collection cycle or the working capital cycle. That one tries to calculate the cycle, the total cycle that or the total length of time that the company goes through when it expends cash on the operations of the business to when it gets the cash back. So basically it is addition of the inventory turnover period. So we have expended cash, we have gotten inventory ready. Inventory will sit there for some days. So the number of days inventory sits there plus the number of days when the inventory gets sold, it takes customers to pay back, minus the number of days it takes us to pay our creditors. That is the cash operating cycle or the working capital cycle. I want you to calculate that because we have calculated the inventory turnover period, we have calculated the receivables collection period, and we have calculated the payables payment period. Give me just about 5-10 minutes. I am sorting someone out. So do that calculation. When we come, we continue. Just about 5 minutes, please.
Please, colleagues, what are we calculating? I heard we should calculate something. My network wasn't too good.
He said cash operating cycle. Hello, Fred.
Yeah.
He said cash operating cycle.
Oh, okay. All right.
James, what's the formula?
I mean, he talks fast for me. I didn't get it. He should have even written it on the how do you call it, the platform for to see. I didn't get it.
You are funny, James.
Yeah,
James.
Please, who got the formula?
Are you listening? I think, although I didn't get the terms, I realized that you said the number of days that we have worked already. So you remember the first one when we worked, we had 26 days.
Yes, 0.5.
The second one we had 44 days.
43.8. Yes.
44 days. So when we add these two and subtract the last one, which we had approximately 45 days, that should answer the question.
So inventory.
Distance education for them. Come on, distance for them. I can see him. I'll pop my cross-side. I hope no parking. See, I will lose our funding problem. So the distance work. However, in a few minutes time, and you can help me. Or sounds about my run, or sounds about pet, member, take off quickly. And hello class, sorry for that. Are we done with the working capital cycle, the cash operating cycle?
Yes, sir.
So what did you get?
25 days.
Let's do it. First of all, the inventory turnover period in days. How many days? How many days was it? Please speak out.
26.
Sorry, 46. 26. Good.
26.
26 plus the receivables collection period.
44 days.
44 minus payables payment period. 45.
45.
So this gets us to what?
25.
What? 25
days. Yes.
Is it 25?
Yes, sir.
Okay, so the
25
cycle,
days.
the cash operating cycle is quite good. So when we spend money on operations, in 25 days time, the money returns back to the company. 25 days is not even up to a month, which is a huge it's a good statistic. If it is too long, then it means that the company will be without cash for long, and the company will go into liquidity problems. So that's the cash operating cycle, working capital cycle. So we are done with the efficiency ratios.
Hello, sir.
Any question?
Hello,
Yes,
sir. Yes, sir. Please, I want the formula for the cash operating cycle.
The formula is closing inventory turnover period plus, let me write it for you, sorry. Closing inventory turnover period. This was 26 plus plus trade receivables collection period. This was 44, right? Plus trade payables payment period. There's the formula.
So is it minus?
Hey, minus.
or plus?
Sorry.
Yes.
Sorry, minus.
No,
So this is plus. This is minus. Okay.
Okay. Thank you, sir.
So that is it for the efficiency ratios. Let's do quickly liquidity ratios.
Oh,
time as one.
So please, I want to ask a question.
In the time as you have doing. Marty. We have a few of the ratios. We have liquidity ratios to talk about, and then we have long-term risk and capital structure ratios, and then investment ratios. We have this to talk about. Then we are completely done with ratios. So that any question that is provided you read, any question you will be able to answer and do a good commentary. In fact, you can assess a company's health and provide a better information for decision making.
Sir, please, I would like to ask a question.
Please, you can ask.
Sir, please, per the calculations we've done so far, we observed that the asset turnover was increasing compared to the previous year. But when you look at the gross profit margin, it is reducing. When you look at the net profit margin, it is reducing. Meanwhile, the inventory turnover, the trade receivable collection period, and then all the other efficiency ratios that we have calculated so far looks to be a bit fairly better than the previous year. So how it could be accounting for the decrease in the gross profit margin and the net profit margin? Why is that? It looks as if we are generating more revenue, but then the profit is reducing compared to the previous year.
Okay, so it will. I think the first point that we have to look at is the operating cost. It means that most of the gains we are making from all these things are being depleted by unmanaged. We can't say unmanaged. We don't know how well they are managing. They are getting depleted by the operating costs. So let's dissect this question. It's a very beautiful question. When we resume lectures, maybe next week, since we have not completed, next week I'll continue to complete it. So bring the question on board, but everybody can go and think about it. Go and look at what we have done. Look at the financial statement. The file is with you, is on your platforms. Go and look at them in connection with the question he has asked. Very, very intelligent question. So that we can come home with some answers. We can come to the lecture with some answers. We put them together and then we have the solution.
Hello, sir.
Yes, sir.
Hello. Yeah, can the questioner put that question on both Google platform and e-learning platform?
Good. Please, the questioner. You can go to the platforms. When you put it on Google Classroom, the information will just be readily available on. I think you can download the same app on your phones, and it gives you notification right away by mail and message. So when you put it there, people will see it even right now. So you can put it on the platform. You have to also put it on the university's main platform, just for the sake of those who have a trouble with the Google Classroom running. So put it on both platforms, and then we can get the question and think around it.
Yes. Apart from that, I don't know whether you've also talked about gearing ratio.
Yes, they will be part of the long-term risk and capital structure ratios, which we are yet to do.
Okay.
Gearing or financial leverage ratios and some other more ratios are left to be dealt with.
Okay. Thank you.
Okay.
Hello,
yes,
sir.
Mommy.
Please, the submission of assignment tomorrow, is there any time bound or just by the close of tomorrow?
By the close of tomorrow. You know, you guys are mature people. I can't handle you like I handle the children. The children, they don't work to feed themselves. Someone is working and feeding them. You have a lot of burden. So by the close of the day, there is no time bound.
Thank you.
Please, do you have to type it?
Preferably. In fact, you will submit your assignment electronically, so you can only do so by typing.
Okay, sir.
I sent some videos on the Google Classroom platform. Some short videos on how to turn in your assignment on Google Classroom. That is only for Google Classroom. The same assignment is on the university platform. So the people who will be using the university platform to do that should go and learn about how they will submit their assignment electronically through the university platform. When they send it, I'll get them there. So I'll check from here and there and pick the assignment. If you don't submit it, you have 0.
Hello, sir.
Yes, sir.
So I believe you can use Excel.
Sure. You can use Excel, you can use Word, or you can even, if that is good. I mean, let's do it that way. Excel, so that it even creates an opportunity for us to practice with our Excel to sharpen. What about?
Okay.
Someone is saying something. I can't hear the person. He's saying what about something? Who is saying that? You can repeat yourself.
Excel.
Those who don't know Excel.
Those who don't know.
Hello, sir.
If you don't know Excel, you cannot decide not to know Excel forever. So this may be the starting point. Practicing with this. Try to challenge yourself.
Sir.
You can find someone who can try to help you small. Then you may, maybe through this assignment, you may know the basics of Excel. If you know Word, you can do it in Word. That's fine.
Okay, thank you.
Hello, boss.
Yes, I did my with Excel, but I converted it into PDF.
Exactly. It's
Is it
okay.
appropriate?
It's okay.
Okay.
It's okay.
All right. Thank you.
Okay, so I think this is where we will end the lecture, and then next week we will conclude it.
Before you go, I want to give this resource out for people to check it to also help them. Especially those HRM class. You remember that last semester I gave a book on accounting for managers. It gives interpreting accounting information for decision making. If you go to chapter 7, of that book, most of the things that Sir have taught today, all the formulas can be found in that book. It is a book. Sometimes you can get a copy from Amazon. So if you get that book, those who had a copy can also refer to that book in addition to the books that Sir has already given to us. It is a very, very useful book. The title is Accounting for Managers, Interpreting Accounting Information for Decision Making,
okay,
by Paul M. Golia. Golia is spelled Cowliel.
Okay,
Yeah, so
okay. I think that is very useful information, Raymond. So you can use those books in addition to what we have given you in a way that will help you understand what we are doing. It's the understanding that is the most important thing. Don't chew formulas. Don't just know how to calculate without understanding what you are calculating. And you can only understand by doing some extensive reading and researching. Yeah. Okay.
Please, my last check on the Google Classroom, the date was not changed. So please, I'll plead with
Yeah,
you
I've
to change
changed
it to
the
tomorrow.
date. I changed it yesterday. So the submission date is tomorrow.
Okay, thank you.
Okay, so thank you everyone for your attention.
Yes,
Thank you, sir. Goodbye.
Yeah, bye-bye.
Yes, madam.